everyone, my name is Ishika Jain and I welcome you to BrainVibe. Today, in this episode, we will talk about the things that one should check before investing in a company. Now, before checking the financial statements or ratios, one should look about the future plan of the company. What is the company planning to do in future? Say for example, if I'm planning to invest in a petroleum company, now we all know that the industry would not be growing much, let's say after 5 to 10 years because of the electric vehicles. So one should look at the future plans before investing in a company. With future plans, one should also know about the founder. What is the founder working on? What is his theories and such things? Apart from these two things, one should also look at the NPA, that is non-performing assets. If a company has non-performing assets, then one should try avoiding in such companies. Now talking about financial ratios. The first one is EPS, that is earning per share. The formula for the same is profit after tax divided by number of shares. Now let's say the profit after tax is 10,000 rupees and the shares is 1000 shares. So now the EPS is 10. That means one can earn 10 rupees per share. So one should look for an increasing EPS for at least 5 years. So now talking about the second ratio, that is PE ratio, that is price to earnings ratio. The formula for the same is market price per share upon EPS. Now let's say the price of the share is 100 rupees and EPS we just calculated before, which was 10. So now the PE ratio comes to 10:1. Now what does this mean? This means that an investor is ready to pay 10 times the amount that he earns. Now how can we analyze that a PE ratio is good or bad? So we can compare it with its competitors or the industry PE. For example, if a company's PE ratio, let's say less than the industry's PE, that means the company's PE is undervalued. It says that the company is undervalued and it can grow more. If the PE ratio of a company is more than industry's PE, that means that the company is overvalued and soon we will see a correction in the same. We can also check the PE ratio of indices. So for example, as of now, the Nifty 50's PE ratio is 32 and as per investors, a PE ratio is good if it's in the range of 14 to 22. If it's above 22, it's overvalued and if it's below 14, it's undervalued. So as of now, it's 32, which means it is, let's say, around 50 times higher than required. This says that the correction would be seen soon in the market. The third ratio is PBV, that is price to book value ratio. The formula for the same is share price of the company divided by book value per share. Now what book value is? Book value is assets minus liabilities, which means that if a company is closing, then what can we expect from the company is the book value. So now let's say the market price is 20 rupees and the book value per share is 5 rupees. The PBV ratio comes down to 4. This means that the value of the company, book value of the share is 5 rupees, but an investor is ready to pay 20 rupees for it. So lower the PBV, the better the company. But the case is not same for all the companies. Like IT companies, TCS, Infosys, they don't have much assets. All they have is their office and computers and they have employees working for them. So for such companies, the PBV would be very higher. So one should look what type of company they are looking and then analyze such ratios. The fourth ratio is debt to equity ratio. The formula for the same is total liabilities upon shareholders' equity. So this ratio reflects the ability of shareholders' equity to cover all the outstanding debts in an event of a downturn. So the debt to equity ratio should be less than 1. It would be better if it's between 0 to 5 or 0. A zero ratio would mean debt-free company. The fifth one is ROE, return on equity. The formula for the same is net profit upon average shareholders' equity. Now this explains what is the profitability of the company in relation with the average shareholders' equity. Now a ROE of at least 15% for the last 5 to 10 years is a good company to invest in. Now this doesn't mean that a higher ROE is a good company. In fact, one should also look at the debt of the company because higher debt will lead to higher ROE. So one need to check the debt of the company too before checking the ROE of a company. The sixth one is ROCE, return on capital employed. The formula for the same is earning before interest and tax upon capital employed. Now this ratio helps in identifying the efficiency of the company as it explains us how much the company has earned the return after factoring the capital employed. Now ROCE of around 15% is a good to go, and one should analyze the last 3 years of ROCE and take an average of the same. The seventh one is price to sales ratio. The formula for the same is market capitalization upon annual sales. Now this explains how much an investor is ready to pay on the sales or the revenue generated by the company. One should look for smaller values while looking at price to sales ratio. The eighth and the last ratio is current ratio. The formula for the same is current assets upon current liabilities. It's a liquidity ratio which measures whether the firm has enough resources to meet its short-term obligations. The ratio should be greater than 1. Now here we come to the end of this video. Remember, all these ratios you can check on any company's website, and also all ratios don't apply to every company because every company is different in nature. So please check which kind of company you are analyzing and which ratio you need to check for the same. So if you like this video, please give it a big fat thumbs up. Don't forget to subscribe to our channel. Thank you. See you in the next video.